Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to our research webinar on technical analysis, introduction to chart patterns, which is the first of many lectures on technical analysis. Starting as a stockbroking firm in 1990, the Capital Trust Group has diversified into many areas of business, including global markets trading, margin trading, fund management, corporate finance, property broking, property development, education, IT, and packaging. Capital Trust Securities possesses probably the largest local client base at the Colombo Stock Exchange, and in fact was ranked among the top 2 stockbroking firms in terms of turnover even last month. Today's webinar is the second of a continuous series of webinars that Capital Trust Holdings Group will be conducting on listed companies, sectors, the macroeconomy, technical analysis, and properties. Capital Trust Research Private Limited has successfully identified fundamentally attractive stocks and has been sending technical charts with indicators through WhatsApp to guide clients to buy at the correct time and make above average returns. It is my great pleasure to introduce Mr. Sarath Rajapakse. It is not incorrect if I say that it is Mr. Rajapakse who introduced technical analysis to the Sri Lankan capital markets. He held top managerial roles over the years abroad and in Sri Lanka. He was a director of People's Merchant Finance PLC and was a director of Capital Trust Securities and is presently a director of Capital Trust Properties. He was a special commissioner of Greater Colombo Economic Commission, now BOI, and he was an assistant director general of Sri Lanka Tea Board. He also served as a senior consultant for the UNDP, UNICEF, UNESCO, and several other top managerial posts. He has over 40 years of experience in technical analysis and trading in the forex markets and stock markets in Hong Kong, Australia, and Sri Lanka. Mr. Rajapakse has a Master of Financial Management and Economics from the University of Curtin, Western Australia, Master of Finance with Honours in Financial Risk Management from the prestigious University of Massey, New Zealand, Master of Economics from the University of Colombo, Bachelor of Science from the University of Peradeniya. He is also a Fellow of the Institute of Training and Development and member of the British Institute of Management. You could now type your questions in the chat screen during the presentation. Please limit your questions only to charting and chart patterns only. Mr. Rajapakse will be happy to answer any popular questions as and when received. Thank you very much.
Good morning, everybody. I'm here in front of you after 10 years. That's a long lapse. I hope I'll be able to assist you in, many of you who had attended my seminars before I left for New Zealand, that this will refresh your memory. And for those who are new, and those who are new to technical analysis, this will be a very rewarding experience. And don't think that it's a substitute for accounting-based fundamental analysis. It's a complement. You look at company prospects, companies' profitability, companies' performance in markets from both technical as well as fundamental analysis. They are not rivals, they are compliments. So without going into much details, let us start with our present presentation, which is an introduction, and we are taking you towards what is technical analysis, just a brief introduction, and show you some chart patterns today, which will be available on the YouTube as well, so that you can print it out and use it for reference as and when you need it to interpret charts that are put out. My two analysts who are there are very qualified analysts who are able to bring out excellent charts and indicators, and you can rely on those. In fact, I am relying on those, right? Therefore, with perfect confidence, you can rely on those chart patterns. Let us go into the nitty-gritty of technical analysis, and especially interpreting how to interpret our chart patterns and our indicator reporting on daily reports will be done on Saturday. Today's will be a sort of a preliminary exercise to make you an introduction to the chart patterns that you receive daily, and the small write-up that goes underneath it as to buy, sell, or hold, or whatever, and what it is based on. And for a start, to learn what this technical analysis is all about. So don't fail to ask any questions you have on the chat channel provided, so that I will try to address your doubts or any concerns you have about technical analysis. And let us start from the beginning. What is technical analysis? It's a scientific methodology. It's not astrology. We are not looking at the stars. I can't see anyway through the ceiling any stars, I don't know astrology. But we are using statistical techniques and knowledge of economics to interpret what we see in past prices and their behavior during the past. And that tells a lot. If you want to know about some person, you want to know about his or her past. Like that, you want to know about a stock. You start by looking at their past characteristics, past behavior. And in your fundamentals, you might learn who's behind the shares or whatever securities that a company issued. So therefore, use them as complements and have that in mind. You don't have to give up all the knowledge of accounting. Many of you are very familiar with it, all these files, because many of the, vast majority of the brokers provide it. And markets, CAC, everybody, publishes information about the fundamentals of companies. But technicals, we are special. I think we are, if not the only, may perhaps be the few who are capable of analyzing technically the past prices and the past behavior of the stocks and whatever other securities traded at the stock exchange or anywhere else in the world, not only in Sri Lanka, because we have access to Reuters Equis Metastock. It was called Reuters Metastock, but Reuters the demand was so high, they floated a subsidiary called Equis, and now it's called Equis Metastock. It was created by Steve Arkalis, and he sold that to Reuters. And the charts you'll see are from Arkalis' book. He made it available as an open source and a resource, and anybody can download Steve Arkalis' technical analysis books. Okay, and so let's go to the next slide. Well, the history of technical analysis, not in the name of technical analysis, starts from the Silk Route area. Silk Route era, when the people from the East, mainly the Chinese, took their raw material, the unfinished products or raw materials to the West along the ancient Silk Road, and which ended in the ancient Babylonia. And there were blossoming markets created in Babylonia. And these Babylonian traders found it useful to record prices and the time those prices prevailed on clay tablets. They didn't have paper. Paper had not been invented then. So on clay tablets, they wrote with a chisel the prices and the time at those prices prevailed in that period. And this was the beginning of the record creeping of price time records. And thereafter, in the 17th century, or rather mid-17th century Japan, there were a blossoming rice market. Japanese people eat rice for breakfast, lunch, and dinner. And they eat rice, they drink rice soup, right? What we call as kandar. And so rice was the grain most popular in then Japan as well as today's Japan, right? In these rice markets, there was a dominant trader, right? Like the Dudley citizen of Sri Lanka, he had Honma Munahisa. And he observed that rice prices plummet just after the harvest, when there is a glut of rice in his stores. They didn't have a modern type of silos, but anyway, they had some, form of silos. And in between two harvests, the rice prices skyrocketed. So what he did was he took the rice from the traders and asked them to store it with him, gave them receipts, and he offered them the service of trading in these warehouse receipts. These receipts were the first futures in the world. So the rice growers took these receipts and sold them to those who are interested in buying rice in between harvests at low prices, and selling those receipts when the rice prices go up, so that they could go collect the receipts, go to Dojima rice futures, the Dojima stores of Honma Hisa, and collect the rice and make a profit in the open market. This was the beginning of trading in Japan. And what they observed at that time was that if you record these on a chart, you could observe some regular patterns. At that time, they invented a chart pattern which they found very useful, called candlestick charts. Currently, we are using it very frequently, or most often, so that a candlestick is used in doing all the analysis in our technical charts. A candlestick has a body. Normal candlesticks in the market has a wick coming out of one end. But this candlestick we use for charting has a wick at the top and a wick at the bottom. We don't call it the wick, we call it the shadow. Okay? It's the open, high, low, close chart was constructed out of this candle. We use usually green or blue or empty candles for candles which begin low and end the period at high. When the opposite is true, when you open high and end low, we use the red color. The choice of colors is yours. You can use fancy colors, gray and mauve and whatever it is. The color is changeable. And only thing is, there are charts with candlesticks with 2 weeks. We don't call it a week, or they never called it a week. And they call it the shadow. So a candle with a body and 2 shadows, upper shadow and a lower shadow. And how does this candle chart, I'll show it on the board, the green candle and a red candle. Green for rising markets, red for falling markets. Can you see it?
Yes.
Right. This red candle, usually this is shaded red. I'm not going to shade it. This, when it's red, when the candle is red, that's the opening price. That's the closing price. This is the closing, that's the opening. That's the highest price reached. And that's the least price during the time period. If it's a, let's say if it's a, the period can be chosen by us. It can be 30 minutes, 1 minute, 30 seconds, whatever. That's a matter of choice. So each candle, this is a falling candle. Then we can have a rising candle. In a rising candle, this is of course the highest price reached during that period. This is the least price reached during the period. And here we have got the open and the close interchanged. That's the opening price, that's the closing price. Okay, you can shade it, right? To save ink, I have not shaded it, but you can shade it. And that's what you see on my MetaStore. Rising candles and falling candles. Then there is a whole heap of theory developed. Of course, this charting technique, though extremely popular in Japan, it was not available to the rest of the world because Japanese like to speak in Japanese and nothing else. You go to the Japanese embassy, they speak in Sinhalese before they send any diplomat to Sri Lanka. They see to it they are fluent in Japanese. I remember there was an ambassador in the past who could, recite Viridu and Baila in Sinhalese. It's true that all diplomats are supposed to learn the language of the country to which they are posted, but before they are posted there. But Japanese go to the extent of learning their culture. So wherever they went, they introduced whatever expertise they had in this charting to all the countries down the Silk Route. So the candlestick charting technique became extremely popular. So two things were invented at the Dojima rice market. That's candlestick charts and futures trading. Any questions you have, you can ask through the chat channel and they'll convey it to me and I will answer. Right? Round about the same time, another market developed in the West, and which was the Dutch tulips market. You see, though they didn't have planes, whatever expertise developed in the East reached the West through India and Mediterranean Arabs, who traded goods between the gap between Europe and the East. So the Dutch learned about this, and they started using candlesticks as well in the tulip markets in Rotterdam, and the knowledge spread all over the world. Right. Nowadays, we use it very frequently. Many people prefer, rather than open high, low, close bar charts, to these candlestick charts. And they developed a theory, both in Holland as well as in Japan, about how to analyze the patterns they observed, which were very regular. This pattern, a particular pattern is observed, is followed by an outcome. Now, right, technical analysis, just like technical analysis, bookkeeping came also from the East, came to Venice, and where the double entry bookkeeping started. So we had accounting. That is where the fundamental analysis started. This Venetian development spread to the rest of Europe. There wasn't much of Europe at that time. They were called hunters, or rather barbarians. So the Northern Europe people were just either pirates or barbarians. All the cultural development happened in Southern Europe, bordering the Mediterranean. So these Mediterranean developments, due to their close interaction with the East, developed quite fast. Among the pioneers in this was the Fibonacci, who wrote a book called Liber Abaci, which literally means freedom from the abacus. Because by that time, they had learned counting from the Chinese abacus, those frame of balls on a wooden frame and a metal horizontal wires. Even to this day, you go to Hong Kong or China, you will find people slowly, if you ask something and he adds something using a machine to see, it's not a calculator, it's an abacus. So this abacus spread to Europe, and it is a cumbersome thing to calculate, especially complex calculation. If your bill is long, if you make a lot of purchases, to do the calculation with the abacus is a is a very cumbersome task. And so Fibonacci is not a name. Fibonacci means Bonacci's son. Now, who the hell is Bonacci? Bonacci was a minister in the rule of in the court of the ruler of Venice. And Fibonacci's real name is Leonardo. He's Bonacci anyway is known to everybody as Fibonacci, son of Bonacci. He discovered a number system. Not discovered, he really learned it from the traders who went to India. Some Hindus in India had found a number system which had magic properties. The number series starts with 0 and it goes like this. Let me put it on this thing. Is it black? Where? Black is. It has fallen. Right? 0, 1. Next one is 1. Next one is 2. 2 and 1 is 3. 2 and 3 is 5. 3 and 5 is 8. 13. And so on, right? 21 and so on. This number system, as it goes down and down and down, has some magic. The magic one that if you, of course, it was created by adding the previous two numbers, the next number follows. But the magic is not only that. As you go further down, any number divided by the previous number comes towards a particular number, the same ratio, called the Fibonacci ratio, also called phi. Right. A Greek F. The ratio's value is 1.618. It slowly merges towards 1.618. But that's not the miracle. Any number divided by the next number will be 0.618. And these numbers occur so frequently in nature. We have one nose, 2 ears, 2 eyes, 5 fingers, 5 toes, and so on and on. If you count the number of parts in a bone inside anybody's skeleton, animal or human, you will find they occur in Fibonacci numbers. Anything that you see in nature will be, I don't want to give all the details about Fibonacci. You go to the YouTube and just type Fibonacci and you will have umpteen videos on Fibonacci. The magic of Fibonacci numbers. So the Japanese were clever. So also were the Chinese. So they used these numbers to predict stock markets. So most of the things, most of the laws that we have created, most of the principles we have derived in the stock market ultimately are derived from Fibonacci ratios. Phi and the phi. The phi is 1.618 and phi is 0.618, which occurs or which recurs several times or always. You count the stars in the galaxy, you look at the patterns in the galaxy, how the planets and the solar systems are distributed on the galaxy. They are all according to Fibonacci ratio. And why should that be the same in the stock market? For the simple reason, till the most recent development in the stock market, which has not arrived in Sri Lanka yet, we'll try to bring it to Sri Lanka soon, which is computer-initiated trading, right? Or what is called algorithmic trading. Even technical analysis is totally dependent on this Fibonacci magic. Right. This algorithmic trading can be taught to computers. That's the beauty of it. Once it's taught to computers through machine learning and artificial intelligence, computers will do the trade. And you'll just collect the profits. This happened in 2010. But this is 2021 and Sri Lanka has never heard about it even. In 2010, few mathematicians in US overnight became billionaires because they found this trick of teaching computers how to trade without consulting anybody. And using simply this machine learning and what we call as artificial intelligence. We commonly call it as a robot. A computer can do about 6 trades in a microsecond without anybody's assistance. Microsecond is a millionth of a second. In a millionth of a second, you do 6 trades. And the amount of profits you can collect is enormous. So much so, the world's largest market, the Forex market, the daily turnover turned from 2 billion to 3 trillion. So if you go to, if you have a Google Scholar, go to the $3 trillion riddle in the markets, you will find enough articles, scholarly articles of research done and how on earth that this happened. How the 50% increase in trading in the world's largest market, the Forex market, happened overnight. And not created by traders, but created by mathematicians. So that's the future. We'll get it someday, but till we get it, let's master technical analysis and become rich. Philosophy of technical analysis is that everything is discounted in price. You can analyze accounts, past accounts, the fundamentals, everything. But all that is in the prices. What you have to look at is the past and the past behavior of the price. Past prices and the past behavior of prices. If you analyze it perfect, you learn everything. So what you need is a thorough analysis of the past prices and the past price behaviors. Right? And this market action is repetitive. Right. In fundamental analysis, information contained in published accounts, prepared by financial accountants. We use it for trading in securities. There are several keywords in it. The information must be published. You can't use, information leaked out or make to leak out using what is known as insider trading, which will give you a stiff jail sentence anywhere in the world. And the word financial accounts is because nobody has access to the other type of accounts, which is called management accounts. Here we have management accountants and financial accountants. In US, you have a treasurer and a controller. Treasurer is the financial manager. We call him the finance manager in Sri Lanka. They call the treasurer. And the controller is the management accountant. Why do we have two accountants? Because we have a lot of money to pay out, or no? Because the financial accountant has to report published accounts, the P&L statements and the balance sheet and so on, right? Funds flow statements and all that, according to rules and regulations governing his profession. Financial Reporting Standards, FRSs. Now, that's available to public. But what is prepared by the management accountant is top secret, or at least supposed to be top secret. If you have a pipeline to the management accountant, you can get all the inside information, though it's highly illegal. Therefore, management accounts information is not available. That is why we resort to technical analysis. we have to know everything. But unfortunately, financial accounts give the publishable information. Let's take Mr. X and Y. X sold shares in company A and B. If he had management accounts in the A and B, he can use the information he got and pass it on to company A, who is a competitor. And therefore, something unfair is done to company B. So because of that, the accounting profession and the legal profession, I mean the law, prevents them from getting hold of management accounts. Right. So what's the way out? You have authentic information in management account, but you have published information in financial account. So the way out is technical analysis, which is legal. Right. Then the problem with financial accounts is that financial accounts can be bent. Go to Google Scholar or any other site where research articles are published or listed. You will find a word called creative accounting. A lot of people are doing research on this. That is, without breaking any law or any accounting financial reporting standard, telling what is not true, right? And that's called creative accounting. It's also, later on they found that creative accounting looks like some artistic, creation. So they introduced the name earnings management, EM. So if you are going to the Google Scholar, you can see creative accounting as well as earnings management. There are a whole heap of books and articles written on this. People are doing active research even now on how to do it and how to avoid it. Right. Right. Having spoken at length about the history of the evolution and merits and demerits of technical analysis, we now come to the details of technical analysis. We start with chart patterns. The chart patterns that exist. The commonest are the line charts, right? And only problem with line charts, it can be based only on either opening prices or highest prices or lowest prices, or least prices recorded, or the closing price. Very often used is the closing price. So it's a sort of a point information that's used in making line charts. They are just lines of closing prices. You join the lines, join in the closing prices. I'll show you the line chart. Don't worry about it. Open, high, low, close bars or OHLC bars, we commonly call as bar charts. show all the 4 prices, but on bars, like this. Did I? Oh no, I didn't. That's a open, high, low, close bar for whatever time interval that we have chosen. If you want 1 minute chart, go back to the book. Right? If it's a 1 minute chart, it's the opening price at the beginning of the minute and a closing price at the end of the minute. Open and close. Then low and high. Highest price reached at during the period and the lowest price. It's a sort of a crude way of representing. And an improvement is our candlestick. Candlestick is much better. You can put dots, but nothing else. Go back to this. Right. Then you have point and figure. We seldom use it here. The point and figure is a rarely used but very compact chart. Any plotting program like the Metastock will plot point and figure chart. Oh, there you go. That's the OHLC bars. Then we have just a line chart. But line chart has only 1 point. That means either closing prices, often the closing price. You can have it with opening prices also, but it comes to the same thing. Opening price of one period is the closing price of the previous period. Right. Then you have the candlestick. More colorful, vivid, attractive. Right. There is corner. The left bottom corner, we have the point and figure chart. Because usually you draw it with crosses and zeros. Here, this particular archivist has drawn it with crosses and boxes. In Chinese parlance, the zero is called the figure. One figure means the 10, right? So like that, so they call this one, X's are points and boxes are. The beauty of this is that it has no x-axis. Point and figure chart has no x-axis. All other charts have an x-axis. Right. The x-axis. What is the x-axis? You know, x-axis has no meaning in the point and figure chart. It's a very compact chart. This can be 1 year, 1 minute, 1 second, or whatever. This is only the movement. This shows a very concise record of the movement. But the beauty of it is that it has the same patterns as in a big chart, which spans over 1 year or so. Right. Next. Now we come to the common chart patterns. Right. These are the common candlestick chart patterns. Well, we have asked our analysts to draw only one chart pattern for a security because of this problem of discerning to analyze these exact patterns, right? A pattern like this is called the doji. You see that the opening price and the closing price are almost the same, if not the same. But it has gone to a higher price, but again reverted back to the opening price. It has gone to a lower price, reverted back to the same as opening price, and ended or closed at the same price. That's called the doji. Then next, it's a candle with a top shadow and a bottom shadow, and a small body, a very, minute body. Yeah, it's called the spinning top. It has gone up, check. It's an undecided market, you see. It has gone up, come back to the opening price. Not sure whether to go to the highest price it reached and it's remained there. Here it has come down to the least price reached during that time period, maybe 1 minute, say. But it couldn't stay there. They reverted back to the opening price, so close to the opening price. But anyway, it has ended a little higher than the closing price. That's why it's green. So the top of the candle body is the closing price. Bottom of the candle body is the opening price. And same is true with the other one. The opening price is the top of that body, and the closing price is the bottom of the body. It has gone to a lower prices, it has gone to higher prices during the minute, but ended up there, right? There's an interpretation to this. If they say if you see a spinning top, if you see a doji, there's an interpretation. Below, these are the candlestick patterns I drew on the board. Then we have this hammer pattern. This thing is called a hammer. There, usually hammer occurs at the turning point. If a hammer occurs, the prices have been coming down and then going up. The direction of the movement of the prices have changed. So that's why I say you must draw big charts. You won't be able to see the hammer pattern if the whole damn candlestick chart pattern is drawn like a ribbon. All the candles will be more or less of the same size. So this type of thing can be seen if it's broadened top to bottom. Then we have inverted hammer here. So you see that when the hammer was a proper hammer or an inverted hammer, the result is the same: falling market turning into a rising market, right? Even if you see a doji, a dragonfly doji, we call this doji a dragonfly doji. That's a normal doji. This is a dragonfly doji. If it's a dragonfly doji, that's a change in direction, right? This is the bullish engulfing. Engulfing means surrounding. You know what do you mean by engulfing? Is that candle, that red candle, is smaller than the rising candle. The bigger candle or the bullish candle engulfs the smaller candle, which was falling. That means the bears have been engulfed by the bulls, which is followed by a upward trend. Okay? Then we have a piercing line. You see? This doesn't engulf it like in the previous one. But nevertheless, it also turned the direction of the market. So anyway, what happens is, if it's a spinning top or say a doji star like this one, this is called a doji star. And we have the, excuse me. This three rising candles is called three white soldiers. If you see the three white soldiers, it's a premonition of a bull market. Going to be higher. Yeah? It's followed by another green, another green, another green, maybe few dojis, and again green, and so on. So these are all bullish patterns. Here are what's the difference between this hammer and this shooting star? Shooting star is an inverted hammer, right? But inverted bearish hammer. That means opening price is followed by a closing price which is low. We have the hanging man. Hanging man, you have the hammer, but hammer is in the correct direction. But nevertheless, what follows is the same. So whether you see a shooting star or a hanging man, you will have a bear market. Gravestone doji, right? There you have a doji here, but with the flat one at the bottom. High, low, open and close at the same, high, low, and close at the same level. That's called the gravestone doji. Then we have bearish engulfing. Always remember, if a chart pattern has the name engulfing, that means this one is longer than that. That means a bearish candle engulfs the bullish trend. See, top of the bullish trend is engulfed by the bearish one, followed by a bearish trend. Top of the bullish one, followed by this is a dark cloud. This is not as bad as the engulf inside. Nevertheless, a dark cloud is followed by a falling market. The evening star, the end of a bull run. There's a doji. Yeah. See, if you see now say a bull market means the bullseye in control. Bear market is bear side control. Question. How to define who is in control of the market? If the buyers are in control, you will see the close will be always higher than the open, and also it will edge towards the high end rather than the low end. Always see this one, this is a bullish market. It's a bull trend. Somebody has asked the question, how do you define who's in control? Here, bulls are in control. If you see this, see, bulls are in control. Bulls are in control. If the bears are in control, there. See, open, close. Close is near the day low. That means right? Because there's a question asked. I got the question, right? So the control of the market passes from bears to bulls here, right? Bulls to bears in this. That's why we call it bearish. Bullish means the control of the market passes from bears to bulls. Bears to bulls. Here, neutral candlesticks patterns. If you have them, a series of neutral candlestick patterns. That means an undecided market. There are equal number of bulls and bears. Any other questions you can forward to that chat channel. Right. Before we move out from this, if there are any questions, you can ask when I have while I still have it. Right. This is a key reversal. Notice this. I have drawn line graphs, but you can draw candlesticks instead. But you have these prices sharply have a bull trend. Then there is a long gap between open and close, or high and low, and then it goes down, down, down. If you see this, that means a key reversal in the market. Market is reversing. You don't look the other way and wait. It's a pattern. No, it's not just a pattern. It's a key reversal in the trend. At least for a while, the prices will be coming down. It's better to get out of your position. Forget about the commission you lose. You get out of the position and wait for a key reversal at the bottom. Like that. That's a key reversal bottom. The reversal is at the bottom. After the key reversal happens, you can with confidence buy. Now that is called head and shoulder. Left shoulder, right shoulder, head. If you see this pattern of it, whether in candlesticks or dots or lines or whatever it is, you better get out of it before it. Usually, good point to get out is that head, you see left shoulder, this right shoulder, and you'll notice that usually the right shoulder will be almost the same as or lower than the left shoulder. If this pattern occurs, it will be you can anticipate. You don't have to wait till it goes and hits this neckline, because you are quite sure that it's going to fall. Better you sell somewhere here. Right? Of course, there will be a pullback usually after such a big and drastic reversal. This type of thing is called a pullback. If you see a pullback, next time when it comes here, don't think it's going to come up. This, after you see the head and shoulders, it's not going to come up. This is just to give you some chance to get out and minimize your losses. If you didn't get out anywhere here, you better get out somewhere or somewhere there. Don't panic here, because you'll see a pullback and you come here. Right? That's the good thing in a real time. Sorry, real time chart. Real time means things will be updated as and when they happen, not 1 day later or 1 month later. That's utterly useless. You must have a real time feed. So that I was suggesting that we have after the COVID is over, we have a study big board on the ground floor with a metastock chart, right, available with one of our analysts who will update it. That's the opposite of the head and shoulder. A falling market stops falling. If you are short, in Sri Lanka you can't be short, you can't short sell. But in other markets, people short sell. Short sell means sell after borrowing from the company or whoever it is, right? And sell what you don't own in the hope of returning it after it has fallen down. Purchase and settle the short position. Right, that's the head, that's the left shoulder, and that's the right shoulder. So head and shoulder, whether it occurs at the top or down, is a drastic reversal. There's no other reversal more convincing than a head and shoulder. So if you see a head and shoulder, some people see head and shoulders always. No, you have to watch carefully. Don't imagine head and shoulders. If you see a head and shoulders, see that you change your, in Sri Lanka, as you can't do short. If you are short or if you have sold, now is the time to buy. This is the time to buy. We call this the breakout level. When it breaks out of a head and shoulder, reversal or reverse head and shoulder, buy aggressively. You will recover all the losses during the fall. So any stock showing a fall, a head and shoulder, a reverse head and shoulder, don't ask questions, don't pay the balandon. You can ask, you do straight away go and buy. Seldom such chances occur. Now, if this has gone up, hit this line, we call it the neckline. If a line is being hit several times and a breakout occurs, that's the bullish head and shoulder. Head, shoulder, shoulder. Yeah. Head, shoulder, shoulder, breakout on the bottom side. When it goes through this neckline, don't pray that it will come up again. It might do this, or it might go quite deep that it does this pullback somewhere down here. So don't bank on it. It will always happen. It often happens that it comes back to the neckline. Now, of course, many of our clients who were there in the 2010 era went and bought Metastock real time, and I hope they did very well as a result. So it's a worthwhile investment. It's a worthwhile investment. Not that I get anything out of that Metastock. They don't give us any discount or anything for promoting it, but you don't have to buy from Metastock. You can buy a Bloomberg terminal for that matter. Far more expensive. But have a real-time feed and see what's happening now. Not 1 day later, 1 month later, that's utterly useless. What can you do? No, you can't. Somebody asks, can we manipulate candlestick pattern? No, we don't. They are given by Reuters, and we can't manipulate what Reuters thought. It's standard. You can't manipulate that. If we plot it, we can manipulate, but we don't plot it. It's done by Reuters. That's why we subscribe. We spend a lot of foreign currency and invest in the top of the market technical analytical programs, because it's you can our clients can buy or sell with confidence. Nobody can manipulate that. People at Reuters don't have accounts here, and they don't have any motivation to manipulate. A rounding top. That's though not as convincing as a reverse or rather head and shoulder formation. A rounded top, through practice I have learned, is as good as a head and shoulder. If you see rounded top or a rounded bottom, that's a reversal pattern, which you can bank on. The rounding bottom. If it's rounding, don't wait till it comes there. You can buy somewhere here. When that rounding appears, it never goes back again. Right? Usually, even the rounding may be flatter than that. So that's the advantage of seeing it. After the COVID period, you can visit the research. If you had come in 2010 era, you could have seen somebody always inside my room, right? It's very difficult to get rid of it because I had two monitors side by side, which is, it have been wired in such a manner that a chart that patterns in one monitor goes to the other monitor. The other end of the chart goes to the other monitor. And people want to see that, you can do that. I mean, it's worth, you invest more money, right? And you expose to very high risk than, investing in two monitors. You can easily, with a single computer, you can have two monitors so that you have a more, it's like people go to Cinerama or three-dimensional film, in a place like UK, there's no demand for single screen cinemas. They all have either Cinerama or at least Cinerama. Some have circular cinema. That is because, I mean, more you see, better you can, better it goes down to your head. So a vivid display is very essential. Right. Now that pattern is an ascending triangle. The feature of an ascending triangle is that the candlesticks or bars have a flat top and a slanting up bottom, which is a slanting up bottom, which is called a ascending triangle, a bullish pattern, which at a breakout, usually about 3 bottoms are made, and don't wait till it breaks out. If it goes somewhere here, you know that it's about to break out. So you can buy it. And there it goes. Sometimes it goes up to this flag top. You can see that this is like a flag. It's like a ascending flag. And it goes to the flag top. And if it goes up, it's a very convincing upward move. That's a descending triangle. That's the opposite of the ascending triangle. Flat bottom, slanting down top, a premonition of a bearish market. You can do if you have. How do we use different time frames when trading. A question has been asked, how are we going to use different time frames? You can. Any technical analytical software will give you from 30 seconds to 1 month or 1 year chart facility is given. It's provided, that facility is there in all the technical analytical programs, Reuters or Bloomberg or anything. You have that facility. The time span is your choice, whether it's a 1 minute chart or 1 second chart. You don't look at 1 second chart because you can get the tick chart given by the CSC. But apart from that, even on the tick chart, you can do technical analysis. You can print it out and do the technical analysis on a paper. There's a choice. But you get any technical analytical program, reputed technical analytical program, they'll provide this facility of time interval change. That's a bullish rectangle. Okay. It's two parallel lines and a breakout. I need not spend time on that. You can see what it is. And of course, you can get a printout when you get the handout download. You have a bearish rectangle, which is the opposite of the bullish rectangle. This is a bearish formation. Best time, there is nothing called the best time. If you are investing for the long term, no point in having 30-second charts. Might as well have one way. Somebody has asked, what is the best time frame? Well, generally, if you are a short-term trader, have 1 minute charts. But if you have a long time horizon, you could go for say, let's see, 1 month charts, monthly charts, say, like you say, you are buying for long period. You don't buy and sell. You are not a buy and sell trader. You are a buy and hold trader. They might as well buy for 1 month, go for 1 week or 1 month chart. I hope that answers your query. That's a double top. Not as a drastic change as a head and shoulder, but nevertheless, it's a reversal pattern. Market that is going up does 2 bumps and comes down. Right? And that's you get the double top. This is the bearish double top. You can have the bullish one in a falling market. Falling market does 2 bottoms. Here it's doing 2 tops. Instead of that, it can do 2 tops. So somebody, now I know what you mean is that you get the chart in the morning and then again the next morning, and it's very difficult to make decisions. Of course, we only help is that hope that COVID will go away soon and you'll be able to see it. there was a time, you know, we can't enter the brokerage because there's such a chock-a-block of people. So therefore, they had access to the monitors because the traders had access to real-time monitors, and people come to watch the market as it's moving. That's a natural tendency. Out there in Hong Kong, they have these, scrolling screens all over the trading hall where people can watch the trading movement as they go. And a mad rush for the Reuters monitors. At that time in the 1990s, internet had just come, and we had 3 monitors, Reuters. There was no Bloomberg at that time. Yeah, that's the neckline. If somebody has asked how to determine the neckline, that's the neckline. Yeah. Second time it hits this. But mind you, that could be if this is a little rounded, that can be the neckline. There. If it doesn't make a breakout here, watch for the breakout here. So I was telling you that if you are a day trader, or what I mean is you buy and make a profit and then get out, that's a different story. But if you are buying a portfolio, of course, you don't have to have a meta stock or anything. You decide to buy, acquire a portfolio and then forget about it. You buy for the long term. In between, many things can happen. But if you want to maximize your return by buying on every up move and selling when the reverse happens, then you have to invest on the choice is yours on a chart service. They are not exorbitantly priced as you think, but the amount of money that you can make by a private chart providing service subscription is nothing. The cost is nothing compared to the amount of money you can make. So most of the big investors out there in Hong Kong had them, even in Colombo. When I was at UNICEF, there were consultants who had 2-3 monitors in their house. We are supposed to come there and work for a while, but generally you have a lot of free time. So might as well, if you are addicted to trading, you can do the trading. That's the other double bottom. Not as convincing as a head and shoulder reverse, but nevertheless, it's a change in direction of the market. See this? Buy it. Sometimes you may be seeing this one is short here and going up. No, it doesn't matter. The 2 bottoms need not be the same size. But I mean, for illustration, we have shown it as 2 equal bottoms. And so there would have been a lot of people who bought at this price, right? Thinking it's a single bottom. But it went down. Of course, you hold on to it and then you double your position, right? That's a triple top. That's almost the similar as a head and shoulder formation. The triple bottom, same as a reverse head and shoulders. But remember, reverse head and shoulders or a normal head and shoulder is a more convincing. It's an emphatic reversal than just three tops or the three bottoms. This is called the diamond formation. Imagine you don't have that diamond. The diamond has been drawn by us. So, but nevertheless, it's the diamond. So you must be a pretty imaginative also to draw that. See the diamond in a pattern. You buy Reuters or Bloombergs or anything, they won't. You don't come ready-made diamonds like this. You have to draw them just to see, make sure that there is a diamond. Right. Now, this just like that rising triangle, don't confuse it with the triangle where we had a flat top here. Here it's a wedge, wedge. In Sinhala, we call it as kunye. So it's like a kunya, right? Now, when you have that, whereas the rising, the ascending triangle, had this one flat, like this. Like this. But if it's like this, right, and comes out through here, that's a rising wedge. It's not a rising pattern, but it's a falling pattern. So when it falls through the supports, this support here, support here, support here. Sell here at the breakout. Mind you that even if you buy Metastock or Bloomberg, you still have that part, these lines will not be drawn for you automatically. You have to be imaginative and work out the lines. So it comes through practice. If you have the other side of the wedge, earlier was a rising wedge, now we have a falling wedge. Whereas rising wedge is a bearish pattern, a falling wedge is a bullish pattern. Yeah. When it comes out of that slanting side. Mind you, both sides are slanting. The support line is also slanting. That's the difference between the triangle and the wedge. Wedge, both sides are slanting. But the top side is slanting more. Right. A V top. It's almost like a normal top, right? Not a rounded top, but a V top. Again, a reversal. That's a V bottom. Same effect as a rounded bottom. But rounded bottom is more convincing. Remember, rounded shapes are more convincing than these pointed shapes. That's a symmetrical triangle. This is going up, that's coming down. And a breakout. Now, symmetrical triangle, you have to watch for the breakout. You can't say while it's going here whether it's a symmetrical triangle up or down. Gap in a trade. This happens in a very bullish market. See, this is an empty space. The top of this highest price reached and the least price reached in the subsequent period. There's a jump. That's called a gap. Earlier people thought that one day this will come down to fill that gap. But now they think that such things don't happen, the gap filling. Right? This is a sign of very bullish. They're so bullish that they don't mind not filling that gap before going to that. Right? While I was in Hong Kong, people believe this gap filling will have to be done. But now you don't see this gap filling. Not that they don't sometimes come down and fill the gap, but it's only old-fashioned traders who bring down the prices just to fill the gap. A similar gap on the way down. This is even more seldom happening, this gap filling coming here. That gap is there. It's only that it shows the enthusiasm to sell. Right? Upward moving gap is enthusiasm to rise. A downward moving gap is the enthusiasm to fall. Gap in an uptrend, okay? Oh, sorry, I'm pressing the wrong button. Right, these are common gaps. See, this type of gaps occur. See, they never come down and fill that gap. It goes on its way. This type of a thing, right? A sideways rectangle. This is called a rectangular consolidation. It's a way the market pauses and thinks for a while. Right? Thinks for a while. Market falls and things for a while, undecided market. But nevertheless, after the thinking is over, it's going up. See, one premonition of this bullish move here, breakout here, is that this one never came down here, right? It never came down to the support line. Shows that the bullish pressure is higher. How different the wedges and triangles. See, triangles, there are three types. With a flat, somebody has asked that question, how different are the wedges from the triangles? Triangles have of three types, flat top and a slanting up bottom, or a flat bottom and a slanting down top, or a symmetrical triangle with a slanting down top and a slanting up bottom. That's a symmetrical triangle. I hope that answers your question. Wedge, on the other hand, either both are slanting up or both are slanting down. If it's a rising wedge, both sides are slanting up. If it's a falling wedge, both sides are, top and the bottom sides are slanting down. You see a flat top triangle, and there is a breakaway gap. Just at the point of breakaway here, there's a gap. We call that the breakaway gap. That shows the eagerness to go up. We call that breakaway gaps. We often see that. When it breaks out at the flat top of a rising triangle, we have ascending triangle, we call that the ascending triangle. When the top is flat, bottom is slanting up. It hits twice. Yeah. Third time, it's so enthusiastic, it jumps out of the triangle. That's a breakaway gap. Runaway gap. There's no triangle, but it's an upward move, but there is a gap here. That's a runaway gap. Not a runway. Runway is at the airport. This is a runaway gap. How to? Still you can, somebody is asking how to decide on the patterns when the market is stagnant. Yeah, market is stagnant doesn't mean market has no life at all. It will just go horizontal. So you don't see trends or gaps or anything. It'll be sluggish. It will show a wait and see pattern. Like that horizontal rectangle. No particular or symmetrical triangle. Undecided market. About to decide. Goes to the top or goes to the bottom. So from a symmetrical triangle, we can't say which side it will break out. It can break out on either side. exhaustion gap. This that was a gap we saw on that trend line, the trend pattern. I would call it a impatient gap, you know, the impatient to run up. When something bullish is happening, all of a sudden they will always do that, jump up. That's a reversal pattern that we haven't seen yet. That is, you see, there is a exhaustion gap here, right? And on the downside, a breakaway gap. These three lines or these 3 days or candles are isolated. These are this we see sometimes. It's a sort of a very emphatic reversal pattern. It's not a mistake. It's very deliberate reversal pattern. We call that the island reversal. The prices in this is in an island, devoid of any contact with the falling or rising bed. If you see an island reversal, it's a convincing reversal, just as convincing as a head and shoulder. The difference between an exhaustion gap and a runaway gap and a breakaway gap, because runaway is a big gap which occurs on the way to the top and are followed by rising ones. In an exhaustion gap, at least 1 or 2 will be up, maybe, but next one will be a falling price rise. Yeah. Up, fall. So that's market is getting exhausted with running up. Have been run away with a runaway gap is a significant gap. This is all of a sudden it breaks out of a horizontal. This is a rectangular one. It breaks away with this from the rectangular box. And then it runs away till it gets exhausted. Gives an island reversal and comes down with a breakaway gap. So these are only names, but nevertheless connected with various real life phenomena. That's a side typical chart that we send always. This is a normal typical one. We hope to send this type of charts rather than sending this one squeezed. We squeezed the vertical axis before just to accommodate various other studies. But if you have so thank you very much for the there is a question, sorry. Ascending wedge is bearish pattern, right? What is the psychology behind this? Well, somebody is asking, an ascending wedge is a bearish pattern. What is psychology behind that? It tries to rise, but doesn't break out of it, right? So therefore, it falls through the rising bottom of the triangle. Okay. Thank you very much. You have any more questions, you can still forward them. Right. If you think of a question tonight when you go to sleep, you can send me a WhatsApp message to my phone number, and I will answer it whenever I have free time. And thank you. We'll see it. See you with the next. But you have another question. Can you order these patterns according to significance? Well, I mentioned that during the presentation. Some say, for instance, head and shoulders is if head and shoulders and reverse head and shoulders very significant. Okay, that's the most significant. Then undecided ones are the sort of like symmetrical triangle. They are called consolidation pattern. You go to a certain price, not decided whether to go up or come down. So it moves up and down and up and down in progressively narrowing gaps, and then you stop. Okay, and anything you think of, you look at the YouTube and send to Prashani or me anything, and you will get an answer soon, right? You will. I think you will have it on the YouTube for a while, so you can download it or you can save it, and then you can you have a record of what I said, and they are absolute truths, and therefore there's no problem. How maintaining it. So and our mission is to help you in your trading and making you rich. But having said that, technical analysis is true, fundamentals are true. That there is another true thing I learned while I was in New Zealand, is that we had a portfolio analysis unit we studied, and we found that the 1980, I think, he won the Nobel Prize for it, Harry Markowitz, for portfolio diversification. He preached about having more stocks rather than putting all your money in one stock. So have stocks from various sectors, various orientations, maybe political, maybe otherwise, but buy from. If you look at my portfolio, I have about 103 or 104 different types of stocks. So all selected, and I stick to it for a long term. Come good times or bad times, I stick to it because I have found that portfolio seldom goes down drastically. it will edge a little bit low, it will edge a little bit higher, but nevertheless, the highs will be more than the lows. So therefore, what Harry Markowitz got the Nobel Prize was for proving that well-diversified, well-selected portfolios are better than anything. But in selecting that, it will, your fundamentals as well as technicals will help. Thank you very much. We'll see you at the next session. Huh? Okay. There's a feedback form given to you or sent to you, and please fill that up, and so that we get the feedback and improve the next programs and improve them to your benefit. Thank you so much. Nice to see you after 10 years, and we'll meet you soon again.
If there are no further questions, I would now like to close the webinar. If you do not get our research reports, please send a WhatsApp to 0777 233 633. On behalf of Capital Trust Research Private Limited, we wish to extend our sincere thank you to Mr. Rajapakse for imparting his knowledge on authentic technical analysis in a series of lectures. We also would like to thank our technical analysts, Udana Valivitigoda and Jinendra Jayatunga, for our staff for organizing this webinar. Last but not least, our valued clients for their participation with short notice, which we greatly appreciate. Hope to see you soon at our next webinar. Have a nice day. Thank you very much.